I'm going to invite Ravi Krishnappa on my right here. So Ravi is a it's very tough to categorize him. He's a serial entrepreneur who's built businesses, been that, exited, but then moved into an area of angel investment. I know that has been for quite some time, but he's been going back and forth in terms of what he want to do and how to really build this great businesses. But then back again here, he's again now back into the entrepreneurial seat after having done it, after being in the investment, successfully scaled and exited as an investor. Now he's back as an entrepreneur. So you go to have a very interesting perspective from Ravi's perspective. And then we have Yogi. Yogi has been building this company Stayzilla. I'm sure you've heard about it. I'll let Yogi talk about it. But the essence of this is both Ravi and I are investors in Yogi's company as an angel. So we're going to rewind the clock and really go back and forth in terms of things of what a founder looks into in terms of valuation, ESOPs and other things, and from an investor's perspective what it takes to really come up with the value for a startup and things like that, right? So welcome both Yogi and Ravi. Thanks for coming here. So with this thing, I know we are running a bit late, but I wanted to open up the broad topics in terms of what we want to be talking about. So the first question, let's dive into this whole thing. Let's take Yogi's perspective on it. I know you've been running a business and then transformed it into an online business. So maybe if you can give a background on what that business and where was the need and when was that you realized that you needed money, because I know you are making money, you're doing things. So a background on that, so we can then set the conversation going, Yogi.
Hi. First of all, we started the company in 2005 August. From 2005 August till 2012 March, we grew out of our own revenues and cash flows. But somewhere in 2011 beginning, I started realizing that I'm not an entrepreneur, I'm a businessman, and the difference between both is the ability to scale inorganically. So when you have to scale inorganically, you need to take money up front and invest it in a right direction. You can't grow based on your cash flows, because we were growing 40% year on year from 2005 till 2012. By the time we received our first investment, we had revenues of 20-25 lakhs per annum, and we were a 25-member team. So basically comfortable, right? So the main reason for us to start looking at funding and start speaking with investors was the realization that we can't grow. The days of growing companies at 30% year on year is gone. It worked in 1970s, 1980s. If you're that slow today, you're going to get eaten. Means that you need to take money and grow 1000% year on year. Otherwise, somebody else is going to do the same thing, and that there is only one winner online or two winners at the end of the day. So that's the reason why we decided to look at funding.
Perfect. Maybe Ravi, we'll change tracks here and hit upon the valuation game, right? So I know you've been on the other side of the table as an entrepreneur when you build businesses, and then later you became very active angel investor. Maybe give a background on what kind of investments you make and what really drives passion for you. But the second half is what are the thumb rules that you really use when you put a tag, put a price, put a value on a startup, especially since none of those theoretical models really work. Discounted cash, everything is a Excel sheet at this time. You punch in different numbers, the value goes up, right? It's all paper, right? It's all. So if you can share these two perspectives to begin with, then we'll deep dive.
Sure. So a bit of background so that it sets the context on the valuation piece that you talked about in terms of history. I've been an angel investor. I've been an entrepreneur twice over. My first entrepreneurship journey was in 1994, when we created a company, and that was before VCs and before any valuation, anybody else, right? And if you can imagine, we sold that company to Oracle, and I can't talk about it because it's not a big deal, right? In those days, the big thing was somebody like Oracle bought you, but then you didn't get take a big packet home in that sense, right? It was more for the process of doing this. Things have changed considerably in that whole context. Why do I is that in a lot of ways, my grooming on valuation has always started with this fact that I want to build something, right? So it's not the valuation at an exit piece that drives me, it's the build process that drives me as an entrepreneur. And I want to make that distinction very clear, because I don't know when you started, but you thinking of what would you exit at, right? Your intention is to build a business. That's the first piece. In the same context, I have invested in about 14 companies, I think 17 that I invested, or 18 that I've invested. One I've completely exited, which was a good exit. There are 3 that went down the drain. So a lot of people don't tell you when businesses go down the drain, they do. So the ratio is not very, very different. You've lost everything that you invested in those pieces. But in the 14 pieces, I think in my own mind, I've gone through multiple phases.
Sure.
I've gone through a phase where I was very actively involved in the sense that I would do only 1 or 2 investments every quarter, and I continue to do that. It was built, those 14 portfolio companies was built over a period of time. I've never invested passively. So if you look at the investment in Stazilla, it was a very, very active investment. I was the lead investor. I don't, just because somebody else comes and says that we are putting together a piece, do you want to invest part of it? I will not, because that's my personal belief, right? And I'm not saying this is right or wrong. A few of these are important to understand, because some of what I say may be very different from, I was kind of listening into the previous panel, because I was trying to distinguish how am I thinking differently from them, and there are quite a few places that's divergent. So long story short, the 14 investments that I have done, most of them are in the angel stage. In most cases, I am the first external person who's given the check, and that's an important factor, because there's nothing really in terms of a cash flow that you are going to value, and all you do a discounted cash flow or any of these things. There's no such model that is existing. I go on a very simple thumb rule that I want to go out, right, to say that if I were running this business and I was very bullish, what would I do? If I was not running this business, somebody else was running this business, I was an independent analyst, what kind of targets would I think are reasonable targets? Figure out what could be the multiple that you can go and figure out, either in revenue or a milestone or any particular parameter that you want to do over a 3-year period, and then go and figure out, say that, look, if I want this, do I want a small play of this? Do I want a big play of this? Do I want a small risk on this, big risk on this? And then out of that will be the magic valuation number, right? So valuation in that sense of putting a rupee price or a dollar price is secondary, while I go and think in that mode.
Sure.
And that's been the same even as an entrepreneur. Because as an entrepreneur, my thought has always been, what's the minimum that I need? What's the maximum that I think I can go and get? But if I go and get that maximum, would it mean that I give up a lot of things? Right? At some stage, you'll go and pitch for the number. You'll always hear people who will say, oh, that's too big a number.
Sure.
It's a question of, oh, that's too, I've never had somebody tell me that's too small a number. But they'll always tell me that's too big a number, either particular piece.
Perfect.
Then you go and try and figure out what the structure is. But as you said, because I have not invested in a very mature revenue earning piece, I don't apply the science to it. I apply more my own image of what is it that I would like to do.
Perfect. Great. So, flipping back to Yogi, as a founder, obviously, you may have had multiple options, either go for more friends and family versus, going with a group of investors like I or other angel communities and everything. But when all these things came up, was there a situation where you had, multiple options, and what was the decision in your mind to say, you know what, hey, option 1 values me at X, so I need to technically part with only less equity, whereas option B values me a little lower, so I'm going to naturally have a better equity control on everything. So what was the process and thinking in your mind going through various options purely from a founder's perspective of valuation?
So when we started looking to raise our seed, we did speak with a lot of funds across, and we did have 3 offers on the table, and IAN was not the best offer in terms of the valuation.
Valuation, okay.
Yeah, there was an offer where the valuation was 25% better, was higher. But the thing that there was Ravi sir knew.
Yeah,
so but we ended up going with IAN because it's at that stage, really, it is art, it's not science. Now it is to a great extent, 25% difference between valuation from one investor to the other is too high a bridge. Obviously, you're going to go for the one where it is lower. But at that stage, we decided that we did require a larger group. We did require active investors who can help cross that chasm from being that business that's been growing consistently at 30-40% to scaling up 5x. Because we knew that our past is a baggage, it's not a strength, right? We are used to a certain rate of growth for the last 3 or 4 years, and changing the way you work and changing the way you look at stuff requires a little bit more active involvement. And we liked the team, we liked Ravi sir, we liked the other leads that were there, and we felt confident that they were all experienced entrepreneurs and have gone through journeys that we have gone through, and they were willing to be actively involved, but not so actively involved that you'll feel pressurized, right? See, every entrepreneur, this thing is only that. Actively involved can mean multiple things. I thought we found the right balance. So, despite getting an offer elsewhere, we decided that we'll go in with IAN at that point of time. And now I think 25% discount, 25% difference in valuation is too high. But for the right investor, yes, maybe a 10%. So at any given stage, valuation at the end of the day is, every investor will have a philosophy that I invest based on this, I look at this, some people look at the team, some people look at the macro, some people look at the micro. And as an entrepreneur, it's better that you get different opinions. When I say different opinions, I'm talking about different valuations. The best is to get 3 or 4 valuations from interested investors, and then be in a position to make the choice of what you want to go basis your goals in the next 2 years, 3 years, what kind of investor you want. It's more than money always.
Perfect. No, I think it's very well said. In a broad bucket of value versus valuation, I think it's very clear that Yogi pointed out that going with value is important, because it doesn't really matter what the valuation is, because it depends on what this money and the smart money that's going to make a difference to the company going forward. So while we are at Yogi, now that you've raised this money, you've gone through this whole thing. Now, what are the different considerations that you take into account when you're now ready for the next stage of growth capital? Were the considerations going to be different? What is going in your mind currently?
So at that point of time, it was more about a lot of hygiene factors, right? Today, it's about support to grow explosively in terms of within India, across. It's not just the capital. At any given stage, you have to choose an investor whom you're comfortable to work with. That's the most important thing. There will be ups and downs. There were ups and downs for us also. There were times when we have not hit the targets. So that comfort is very important. Second thing is support. What is your objective? At this stage, our objective is to continue to grow 10x from the base that we are at, and that means we already are number 2 in terms of absolute room nights. From here, growing 10x is about creating markets. It's no longer about competing. And definitely investors who are not shy about creating markets, those challenges are different, because there you really have to get your hands dirty. Competing you can, but when you're creating markets, it's the next level of getting your hands dirty. So those kind of investors who can value add. Team building is another thing, because at an angel seed stage, a lot of your focus is on getting the prototype and getting the business to a particular level. A team is also a prototype, not completely fleshed out, because $500,000 it has to go to grow the business, make sure that things are successful, prototype wise. You can't have a completely fleshed out team. If you have a completely fleshed out team, go for Series A direct.
Maybe another 10 minutes.
So for currently it is team building, growth, helping us create markets.
Perfect. So,
There's a question.
yeah, is there a question?
Yeah, go ahead.
Yeah.
We've invested in about 14 organizations.
Yes.
Now, one of the things that we've always thought when we are pitching to investors are that their active involvement. Now, the degrees of active involvement can be debated with the freedom. So, how do you manage that?
I don't work with all 14. Having said, if you look at 14, I probably spent a couple of days every fortnight.
1 week in
1 week in Chennai.
I would be in Bangalore.
So if you look at the first 3 months of engagement model, there would always be, in a month we would have a week overlap. That's the level of involvement,
So
right?
what
1
happens to
week
the
in a
balance
month is a lot.
What happens to the balance 13 organizations that you have invested in?
No, I always do this over a period of time.
Oh, so
I'm
they're not
yeah.
concurrent.
So
Yeah.
it's there's no conflict of interest. I do not invest where I see a conflict of interest, because if you look at it, there have been lots of other people, including some who subsequently got funded, who came in the same space that he is in, and he knows some of them. I said no, because I'm already invested in this piece. But I'm working at any given time, I'm working with 3 or 4 max 4 actively. There are some that, you spend, now I spend a day a month, even that's not even come to down, half a day a month.
His philosophy is about, it's like flying a kite, right? The initial part, a lot of grunt work, then it's up and flying. Go to the next flight.
This question is to both of you from the perspective of valuation. Now, I am given to understand that, when you are pitching all the time and 24/7 you're thinking of pitching, suddenly you forget that what business you are in. You're suddenly in the business of selling steaks. And that's not the reason why you started. The idea is something else. So this valuation thing, I value my organization or my startup at a certain figure. Now, I am not supposed to be a specialized guy on that. I am supposed to be specialized in the idea that, or not even specialized, I am in the journey of looking at specialization in the idea that I've thought of. Sure. Now, this business of valuation is science, gut feel, a lot of people talk about it as emotions. What is the right way of valuation? I mean, I should do what I will do.
I'll let him do the piece, but I just finished a fundraise for myself and a new company that I'm doing, but I'm taking a very active role. I just closed that a week ago, so I'm still fresh. Now, the fact that I have been a player, I've invested in 14, did I have to get any other treatment as compared to others? No. Just to give you a feel, for the small fundraise, I have personally spoken, done a demo, each one at least half an hour to 40 minutes for about 55 or 60 individuals, right? So there's no shortcut. That's all I want to say. I've done this. I've been on the other side. I'm an investor. But when I go back and wear my hat as an entrepreneur, I am selling the concept. I'm selling my passion. I'm selling the vision that I am the right person to take that. I have a vision and I want to lead you forward.
How do you quantify that?
So let me come back. The second piece is, how do I do that piece? In my mind, I have a figure that I want for reaching the next set of goals. I need X amount of money. And in my mind, I'm willing to dilute a certain amount to get that X amount of money. That's my balance. That's my personal balance.
This is the entrepreneur talking.
No, yeah.
That's me talking as an entrepreneur.
Yeah, why don't we hear
See, one thing, when you said it's about selling steaks, I mean, you inevitably end up. I emailed 150 investors. Okay, I have met with 60 and multiple times. I would have done probably 200 meetings of VCs for my Series A, right? At no point should you think that you're selling a stake. The thought process should be you're bringing on a partner. See, if it is transactional.
No. I completely agree. What happens is after this multiple.
But then every day you
I'm
wake
saying,
up.
how do you value?
No,
So every day you wake up and think. Every day you wake up and think. It's about finding a right partner. If you are slipping or you are on that slope where you start slipping and start thinking about stake. It's okay, positively reinforce the message. It's about finding a partner. At the end of the day, you have to do it. And even at the seed stage, we had 3 offers. Even at the Series A stage, we had 3 offers. And I'm fairly confident going forward, any round that we raise, we will have 3 offers, because the fundraising is done predominantly by the promoters themselves, right? See, what happens when you do it is you are looking at more than a transaction, and that shows. You can use at later stages investment bankers who will help, tactically get that 10% increment in valuation, but otherwise make sure that it's relationship, it's not transactional. Even an investor who doesn't put in money, make sure you have a relationship with them. You've built a relationship where after 1 year when they see, they are also happy that they contributed something in the meeting towards your growth. And that, don't let it go out to anybody else. Make sure you're part of that conversation. If it makes you feel easier, think of them as consultants. And that's what I thought when I met with every VC. They are unpaid consultants. They have so much of data. I go sit down with them, and 2 hours they're going to spend with me and give me a lot more ideas. I'm not paying them any money, right? Forget the fundraise. That itself is a great value add for me.
Perfect. All right, now, we have 2 more. Why don't you reserve the questions for the end? For 2 reasons. Because
answer it as part of this coverage.
yeah. So the quick thing while you're flipping topics here is ESOPs. So Ravi, I wanted to hear from you, as an investor, what is your thought on ESOP, and how do you use that instrument to the advantage of an investor?
No, as an investor, I would like to have the ESOP reserved for a very, very simple reason, that I don't know the relationship, the chemistry, and the team build structure that has taken place over it. Most people will tell you, one of the first few questions they will ask you, if you're 2 founders or 3 founders, they'll ask you, how long have you known each other? Because they want to understand if you have a long-lasting working relationship that is going to is that mature enough to hit all the bumps that you're going to hit, and you'll invariably hit those bumps. There's no way you're not going to hit those bumps. So that, having done that validation, investor always likes a ESOP structure, because you need ESOP to attract the right people, right? And when I say attract, it's not as though handing out. There is a portion of eligibility, there's a portion of allocation. I think there's a whole lot of confusion to say that if I become eligible, I'm going to get allocated. That's a whole process between eligibility and allocation that you have to distinguish. But it's a great sales tool not for you as an investor. It's a great sales tool for the entrepreneur to sell the concept, to say that, look, I have got reserved piece that I can bring you and make you part of that structure. The only other piece is you will see a few terms in the term sheet that you need to be careful of, and this just as make sure that you go and work through, because they will have a few clauses that says it's non-dilutable to investors. Understand what that means, right? If I see a very small percentage, there are people who come and say, I have 2%, I have 5%, less than 5%, I typically say, forget it, guys. Unless you have a fully built team that has everything else in place, I will say that's not acceptable, because I know for a reason that you are going to get somebody else in, right? And you have to make it attractive for you to go. If it doesn't get allocated, it doesn't get allocated. It sits on your thing, and then we'll worry about it at a later stage.
Perfect. So from Yogi's perspective as a founder, let's assume the thumb rule of 8 or 10, the 8 to 12. I think that's the range. So what is going in your mind, and in terms of how do you allocate it within your employee, and what are the criteria that you apply?
So first, setting up the ESOP at a very early stage, the thought process is different, right? You really don't know what value it's going to add. But at this stage, once you've crossed one more round of fundraise and you've scaled up, that's when you really realize how much value the ESOP provides. So I am thankful that at that stage, IA and Ravi sir did push us to set up an ESOP, because today I'm able to hire people faster because of that ESOP that has been set up, and that is like 10% of the company has been set up for other employees. And another thing that it does is it changes the DNA of the company, right? Once you have an ESOP in place, somewhere you know that pretty soon founders are dead. It's all about team. It doesn't matter who started the company. At some point, if you really want talent coming in and you want to grow, they need to be as committed to to the vision as you are, and that can only happen if it's their vision. Which means at some point you can't have two kind of structures, founders and others. It has to be functional heads, hierarchical. And a ESOP is a good way to start off in that direction. As you're growing in size, things start falling in place. So from that perspective, I would say that ESOP is a value add, which is which is an investment you're making in your own company for later. Look at it like that. Don't look at it as it's coming from my shares or I'm getting diluted. You are making the investment in your company, and at a seed round, that's the best signal you can show to investors. Because when you are asking them for money to invest in your company and you're telling that this is the amount of stake I'm going to give, obviously you can't invest your money. If you had, you're not going to ask them for money. But you can set up an ESOP. That's the investment you're making in your company. Sure.
Yeah, so one other piece, it definitely impacts a bit on the valuation place in some ways if you think about it, especially if you go back and work through. So the only point that I'd like to make at this is that ESOP is also a good buffer for you to go and figure out what you're going to do on a clawback and a bonus clause and try and link that piece, because it again goes back to a pool structure, and that gives you a bit more flexibility in how you want to do, right? So when you do the deal structuring, when I say deal structuring, when an entrepreneur and an investor going through, there's a whole lot of discussions that you go through, and you know, it's not, at that time, it's not so much about, you know, is it 7.5, I will walk away from the deal if it's not 7.5, is it 10, is it 9, it's not so much. That, it's more about how do you want to structure this, where do you want to build that buffer, and that's also a part of the deal structuring process. That also gets to you to know each other much better.
Perfect. So I know we're running too close to the time, but we're going to have a separate session only with investors. So hold back your questions for that session, because we'll have a panel of investors. One other final question to Ravi before we wrap up and maybe open one or two questions. I know we've sat down in a lot of deals. Everything is perfect. All thumbs up for the team, everything. But then once you get down to the weeds, the cap table becomes a big shocker sometimes. And so what really happens? And so I wanted to kind of share some of the experiences that you've had as an investor in terms of what are those founder-friendly cap tables or investor-friendly cap tables that will kind of give some runway and give some leverage, from perspective of an angel investor. Because for you, end of the road is having a Series A come in. Sure. So how is that process go through in your mind?
So again, I can't speak for the next round or the one before. I'll start speaking for myself. It's a very, very important question in the sense I'll say it differently, because as an entrepreneur, you're always told that there is a angel coming in and wants X percentage of the company, right? I mean, I'm sure. And what's that X? I've heard ridiculous figures. I've heard figures as high as over 50%. I mean, I'm serious. I'm not making a joke. There is somebody who came and said that I'm going to do this. I'm the founder, but this person wants to put in the money and take higher than that kind of figure. Just run away from that deal, right? Because you'll also have people who will go and say, I will give you a very small amount, I'll take a very, very small 2 or 3%. There's really no play in that. Why would you get an angel and go through all of that for a very small amount? In my mind, there are 3 things that I watch out for. As an angel, I'm going to get diluted at least, hopefully twice, which means I'm going to hit a Series A and a Series B dilution, 2 rounds of dilution. Each of those rounds, in my mind, is going to ask for 26% in the company. Right? Why 26? Because that gives them the board seat, that gives a few other things. So my preference is to be left with, either as an individual or as a group, to be left with more than 6% at the end of all that piece. Do the maths. I will walk away from the deal if I get less than 10% as a group or individual. I'll say this is not worth my time. That's my personal opinion. I will also walk away from the deal if the entrepreneur is willing to give up more than 30%. Right? Because then I don't know what's going to be left for that person to run with the ball, right? I'm going to say I can't run this. Active angel doesn't mean that I go and sit in that person's place. So, and again, don't take this take this as my thumb rule. Each individual may have a different piece, but for me, it's 13 to 30 is the range.
Perfect. Yeah, I know we are too short of time here, so I'd like to quickly wrap up this session. Thanks Ravi, thanks Yogi for your time.